Hi everyone, and thanks for joining us for part 4 now already of our webinar series where we deal with tax efficient structures, especially in the offshore space. Joining us today is Etienne Bosch, Regional Manager in Cape Town for Old Mutual International. He'll share a presentation with us that hopefully answers most of the questions on offshore endowments specifically, and cover a few topics such as the benefits of using an endowment in the offshore space and looking at the tax and succession planning factors, and then also explain how the process works of investing in it, and also comparing them to a few other structures such as your trusts and your local endowments, etc. So thanks for joining us, Etienne. Over to you.
Thank you, Alfonso. Yes, thank you very much for everyone joining. I appreciate everyone's time. We've got a sort of a crunch time to get through quite a lot of information, but I really appreciate everyone's attendance. It is quite an interesting, let's say, intense discussion in some points. So the reason for this session is more to be more thought-provoking and just to give the reasons on why, like Alfonso and Tom, it's quite an intense work on their side to make sure that they use the right structures and just to highlight some points that they need to consider when placing investments for you as your clients. So firstly, I just want to talk about the idea of the agenda for our session. So I have a lot of clients that do think when they invest on local platforms that the local platforms with offshore investments are exactly the same. So I'm just going to highlight some misnomers where people are slightly incorrect, and then I'm going to talk about offshore investments and investing through different structures, because every time you invest maybe through a company or an individual or a trust, it has different implications to investors on tax and so forth. And then specifically, lastly, I'm going to briefly touch just on estate planning and the implications if you do not structure it correctly. So if you look at it on the first slide here, this is exactly the same fund that an investor will invest in. Exactly the same manager, same fund. The one is just the direct offshore equivalent, namely the red one, and the blue one is the locally available fund on a local, let's say, endowment, which is just a RAND feeder. So you sometimes see a fund's name as, let's say, 91 Global Franchise and a 91 Global Franchise feeder fund. So a lot of times the interpretation is it's exactly the same fund, you're going to get exactly the same performance, but that is in majority of the times, 99%, not so. So the reason for that is you can actually see over here, the performance in dollars is around a 20% difference over a 14-year period. It might not sound like a lot, but it definitely has a major impact for a person's investments. If you look at that performance in rands, when you translate the dollar performance, in this instance, it's around 70% difference over a 14-year period in rands. So a 70% performance has definitely got a major impact on a person's financial planning. And that's why it's critical that clients do not just proceed with investments. They need to approach advisors for correct structuring. So if you look at the reasons for the difference, local funds, when they invest overseas, they actually need to use what is called an asset swap facility. It's not expressed as a fee percentage when you look at the fund fact sheet, but it is an implicit fee in a fund fee when you look at what they call a total expense ratio or a TIC. So it might not be much, but it might be, historically, it was probably around 0.5%. But now, even if it's a difference of 0.2%, it's still a 0.2% fee that you're paying, accessing it locally to invest overseas. Second component, again, is also, it sounds like a small fee, but all these things add up because the local fund managers, it's a VATable service doing fund management. So if you add like a VAT fee on, again, it's maybe 0.1, 0.15%. That is a further fee that is drawing the performance down, which you do not experience on the offshore side, because they are, as I placed there, tax-free havens. So it's an old term, but it just explains the structure or the better. Lastly, just maybe on a more technical point, even if you look at the performance being on the top line or the lower line, the lower line being South African funds, the funds are what we call distributing class funds. So all the interest and dividends that you actually receive in the fund is paid out to investors on local platforms. Platforms do administer it well, whereby they're investing it back into the fund, but you would receive an IT3B and an IT3C at the end of the year, which you then have to supply to SARS. So the downside of that is, even if you're in a balanced fund or a cautious fund, you would potentially receive interest in that fund, and that interest is then taxable at your full rate of 45% or up to 45%. So, which in essence is not a good rate, because if you invest overseas, all interest and all dividends is rolled up invariably. So you're actually converting interest into dividends, into capital. So you only pay 12% in the instance of Mutual International. I'll get to a bit more details later. So it's a few technical points, but I just want to highlight that, you know, offshore, if you want to invest offshore, it's actually better to go directly offshore. I don't have a problem again with asset swap funds, but it's more horses for courses. If you're an investor who wants to maybe invest 100,000 Rand overseas, going offshore on those amounts or less, maybe not feasible on a costing perspective, and then an asset swap fund is suitable. But if you're a larger investor who wants to put anything, let's say 500,000-600,000 Rand up to, you know, larger amounts, you know, the after-tax returns and the fees that you're paying might not compensate for that efficiently. And that's why it's important, because a lot of times people do think they invested in exactly the same thing, and where individuals like Alfonso and Tom gets more involved. Just further on the calculation on the impact on tax, I've just used an example here. A lot of times people think, again, you know, if I invest overseas or locally, my tax rate's 12% or 18% or whatever the tax rate is, it's exactly the same. It is unfortunately not so. I just use a quick example over here. I'm not going to go through the full analysis of the calculation, but in short, if you actually look, if you invested 5 million Rand, growth is exactly the same. And if you look at the value at the end, is both, in this example, 8.75 million Rand. However, if you get taxed on the dollar growth and not on the Rand weakness growth, then you would actually come out with a lower tax return, lower tax payable, and which will in effect give you a higher net after tax return, actually rather just being taxed in a hard currency versus taxed on a Rand based scenario. I also get quite a lot of times the investors who think because they got a SA trust that they are not possible to invest overseas. So from a pure legal perspective, that is correct. A South African trust cannot go and apply for their 10 million Rand allowance or a million Rand allowance, however, to actually invest directly overseas. However, there is ways and means around actually creating a personalized asset swap facility for the trust. And again, as I said, those fees are considerably lower. But then you actually have, as a trust, the full facility to actually invest overseas, and you have the full capacity of all the investment options Carrick is available to supply you as investors. However, on top of that, if you actually structure it correctly, you could potentially then place the local trust assets in a offshore endowment, such as Old Mutual International. And our capital gains tax rate is 12% versus a local trust, which is income tax rate is 45%, and also from a CGT perspective, 36%. So there's a massive disparity, or let's say arbitrage, that a trust can facilitate. And we do the tax on behalf of the trust, so it makes things much simpler. I'm not talking about the conduit principle here, because I do know it can be utilized, but it still brings the rate down from 18% down to 12%. And again, on top of that, we do all the tax reporting, because the scenario is if a trust distributes to, let's say, a local beneficiary, there's a lot of disclosures that's needed from the beneficiary, bank's contact for information. So there's a lot of simplicity in actually packaging the trust assets, having a full access available overseas, and then on top of it, being taxed on the dollar return rather than the Rand return that a local trust invariably would just platform. The same scenario applies for companies. There's not a difference in tax rate for companies. It'll be good if there's many more companies that have cash available to invest now for this tough time that we're going through. But we do get quite a lot of these cases where companies do invest overseas, specifically because SA companies, the directors don't want to pay the 20% withholding tax to actually distribute it out to shareholders. So they want to keep it in the company, but they're looking for options to invest overseas. Again, we can make a personalized asset swap. I mean, if you have any questions on this, you can speak to Alfonso and Tom, but we can create a personalized capacity for the company, then go and invest overseas in the full range that's available on the platform. And again, importantly, the assets will then be taxed on the dollar return rather than a rand return. And being that companies have a much higher capital gains tax rate, the impact versus the calculation I did earlier is magnified. So you easily sit with nearly twice as much capital gains tax that you pay on a local platform than actually administered on the direct offshore side. So if you look at the structure of just Old Mutual, just to highlight some points here, the investment amount, the minimum is around $30,000, and that sort of talks to the scenario of if you want to invest 100,000 Rand, a local platform, or 200,000 Rand, a local platform is suitable for that. And as you build up capital, then you can directly invest overseas. So even if I look at my own personal capacity, I invest on a monthly basis on offshore local platforms, and then once a year, every second year, I then extract an amount directly overseas. So it's a good building block, and then obviously with advice from an advisor, then you can structure and take it over directly overseas. So structures like these are available for individuals. Also special applications. So we get quite a lot of clients who has, let's say, they've used their 10 million Rand allowance, but they would like to take out more of them, but pessimistic on South Africa or the Rand or investment opportunities overseas. The scrutiny on those investors and the disclosures that they need to supply is much more onerous and intense and required on an annual basis. Again, our structure would absolve them from all of those issues that they will have, and we issue clients with a tax letter saying all their taxes are sorted at a much more preferential rate. I'll touch on offshore trusts just now. There's a specific place for them, and the world has changed considerably in that space, but it is definitely available. And if anyone that's watching that has questions around offshore trusts and investing in wrappers and why is the benefit? Because a lot of times people think there's no benefit. There is still considerable benefits, which I'll touch on 1 or 2 points thereafter. I've touched on the asset swaps. If you look at the investment choices, we come across in South Africa a lot where people purely just go after the actual returns and not the structuring of their assets. So a lot of times people have, let's say, approached Investec or Credit Suisse or Swiss banks, Julius Baer, or even local. They purely invest in direct offshore shares, just looking at the engine itself. They didn't look at the actual structuring around it. So all I want to highlight, there's quite a lot of different custodians that's actually active in South Africa. In credits, Carrick Wealth uses Capital International Group extensively for their structures. But again, there's a lot of you that might have direct share portfolios, direct assets, which is, as I call it, lying naked, invested overseas. So there's definitely opportunities to structure these assets, and you can move it in as is and just structure the assets. It's just a point to note that you need to consider tax implications and inheritance tax, which again you can always fix even after you start it. I just heard the quote yesterday again, which I forgot some time ago. I'm not a big golfer, but the whole concept is if you're standing on the tee and you're going to hit off, even a small change has a major impact on your investment in the long run. And the same applies, where the ball ends in the end. So the same applies to investments, because slight tweaks, like I mentioned now around tax, has a major impact for you in the long run. But you can try and fix it. It might not be as efficient as it was when you initially done it, but that's why I think it's important, if you have some of these direct shares directly overseas, that you please speak to Tom and Alfonso, and we can definitely help you from there and forth. If you just touch on the tax, with us as an institution, Old Mutual is a registered insurer in South Africa, we've got fixed tax rates, same as individuals. Ours also get mentioned in the budget every year. So our rate is 30% income tax and 12% capital gains tax. Now again, that is, as I mentioned in the budget, it might sound exactly the same that every insurer says, no, our rate's 12%, but there's sometimes a lot of devil in the detail with offshore structures, and that comes to many factors like even beneficiary nomination. So it's important that the advisor, and it's quite a big job for the likes of Tom and Alfonso, to actually find insurers that they're comfortable with and understand all these things, because there's many nuances. Unfortunately, offshore is not, locally it's much more simpler and more synergies between different platforms. Offshore, there's quite a lot of differences, which can make material impact to you as an investor. And that's why it's a bit more technical and complicated on the offshore side. And that's why you need the advice. And that's basically what I'm trying to highlight in a lot of these slides. If you look at it from structuring point of view, if you invest in direct unit trusts, invariably internationally, they're what we call the roll-up funds. There is actually quite a lot of space for distributing class funds. It's a bit more on the technical side, but invariably people will invest in roll-up funds overseas, and I'll touch on actual implication in a slide or two for that. But if you actually go into like using direct assets, so if you've got money markets, if you're buying direct corporate debt, those types of assets actually yield income tax, and that can be up to 45% in your own rate. Again, if an individual uses an insurance wrapper like Old Mutual, the rate actually is reduced to 30%. And for a person who's earning 400,000 Rand, you're actually reaching the 30% threshold. So invariably, that is a good idea to use wrappers if you are purchasing direct offshore debt. Although there's actually ways to even reduce that further with further structuring. I do get this question a lot around dividend withholding tax. I can spend an hour or two on this alone. It's a very complicated field, and people think again it's exactly the same everywhere around, but in fact it's not so. It's actually one of the more complicated parts in tax. And a point to highlight is not income tax or capital gain tax. We get it a lot where people say, I'm receiving, let's say, Johnson & Johnson dividend. Am I still going to pay another more income tax or capital gains tax? And that's in fact not so. Withholding tax or dividend withholding tax is a separate source-based tax deducted in the United States. So the important considerations there is who's actually holding the share or who's buying it. Where is it? Where are you buying it from? So is it like a nominee in Isle of Man or as an example? And where's the asset and what type of structure? Are you buying it as an individual institution like Old Mutual, or are you buying it, and where is that institution registered, and are you buying it through a trust? So just to highlight some examples below, for example, if you're holding Johnson & Johnson, you could be, as an SA resident, been paying 15% dividend withholding tax, which is topped up to 20%, which is the rate in South Africa. But if you just, for example, hold that same share, but you're buying it through an offshore trust company, you could be paying 30%, or you would be paying 30% withholding tax on that same Johnson & Johnson share. And again, if you take that trust and you actually invest in a wrapper like ours or Mutual International Contract ours, the withholding tax again is, in that example, reduced to 15%, which is then up to 20% from an SA tax point of view. And for example, if you're using a fund, like a normal roll-up fund, in many of those instances, the withholding tax is actually 30%. So there's quite a lot of implications. And again, it sounds small, but like I said, at the bottom of there, it's a difference in payout of 2.1% on the Johnson & Johnson dividend now, versus if you structure it correctly, you can earn an extra 0.3%. Again, it's a lot of these small nuances that actually can make a massive impact over time if you do 2 or 3 of these fixes. I'm not going to go into too much details on that, but I think it's even now when we look at our tax from SARS, they're using a lot of third-party taxation information. There's a lot of information out there, and SARS can question you on anything. And and if you want to go into a world, let's say going naked into shares, you should be open to the idea that SARS can take quite a bit of your time to question you on your tax, etc. But if you structure it into an endowment type of structure, that obligation shifts to insurer, and you will never have that obligation or discussion with SARS. I'm going to touch briefly on estate planning. If here I mentioned benefits of Old Mutual International. It's actually, you can read it if you don't have Old Mutual International, that actually applies. So with us, you don't need a foreign will or local, in that space, whereby if you hold direct offshore assets, invariably you need a will, written in the language of the country. We avoid executive fees in South Africa, which is up to 3.5% plus VAT. We also don't need offshore probate or offshore executors, which is another leg to the payment, and also time delay of winding up estates. And using like a wrapper like ours or structure, we have primary and secondary beneficiaries, so you can actually do quite a lot of planning. So it's not up to the interpretation of the will by the executor on who needs to go to where. It actually just freely flows from one individual to the next. And the timing for that is invariably around 3 weeks. So I think it's a very understated benefit, whereby even if you hold a direct offshore bank account, it could take months to years to actually for that asset to flow from one individual to the next. A point there on no CGT triggered. This is a point where it actually raises that all insurers are not the same. All insurance products are not the same. So if you have an insurance product registered in South Africa, you actually have that benefit, but there's no CGT on death of the investor. So the full benefit actually flows through the next individual. However, if you use an insurance product not registered in South Africa, it's an offshore product. It's also in Guernsey or Isle of Man, but it's not regulated by South Africa. This benefit actually doesn't apply to the investor, and full CGT is liable on the death of the contract holder. And there's just some examples over here how easily money flows from one individual to the next. But there's also options where you can have the amount invested by the contract holder using his 10 million rand allowance or his million rand single discretionary allowance, investing overseas, and then nominating a trust as a beneficiary, be it local or offshore. And that then easily flows money from yourself into the trust. And it's a very easy process, whereby you then obviously grow your offshore wealth. And this sort of leads to a lot of the questions where a lot of people say, is offshore trust better than wrapper? I don't know. I do not think it's either or scenario actually work very well together. And these are, I get the question a lot of people think when you've got lots of wealth, you need to go to an offshore trust. It's not always so. There's a lot of, legislation that came in that sort of cut the benefit of setting up offshore trust. But there's also implications like loans, interest rates, like I mentioned, withholding tax, and those types of things. So the choice for offshore trust or a wrapper really is bespoke to the individual, and that's where the likes of Alfonso and Tom comes in. I've done quite a lot of these calculations with advisors, so I don't want to go through this calculation, but this is just to show at the bottom. Going through the story of, even our asset is still an asset on death, so you would pay estate duty. The same applies with loans. In an estate, you still pay on the loan amount outstanding. But a lot of times people think, now, I'm going to score out of rather going to a trust. And here in this example, just want to actually just highlight the points at the bottom. It's much of a muchness, and the numbers are slightly varying on different return profiles, how much you trade, etc. But you can see the numbers are there very close to one another, and this is after quite a few years. So it's really just the concept of trust or wrapper, etc., is much wider than just tax. It's actually the reason why are we investing in these different vehicles. And again, leads to the advice that comes from Tom and Alfonso. So thank you.
Thanks a lot, Etienne.
A whirlwind tour through some structures. I hope it's well received.
No, 100%. Thank you very much for that, Etienne. I know there was a lot of insights that you've given us there for a lot of people on the call here. I think we got enough time for 2 questions. I think firstly, and I think a lot of people make use of these types of offshore endowment wrappers especially for this reason, is what type of process is actually involved when you pass away and your investments are, as you say, naked, as if you've gone overseas and you've invested yourself versus into an endowment wrapper on your side?
Yeah, so it depends. There's a whole range of options that could be applicable to you. So you might have noticed I'm an Afrikaans individual. Luckily, I haven't put my will in Afrikaans, but there could be individuals that actually have a will in Afrikaans. When they have offshore assets, they could be sitting with offshore shares. Then when you pass away, the offshore executor, he will then say, listen, I don't understand this Afrikaans will, I need to get it converted. That can incur a cost, a time delay. There was quite a few articles already in newspapers where people held assets naked overseas. It's gone on for several years trying to wind up the asset. And obviously you can understand it's a traumatic time invariably for investors. So you'd like to make it as painless as possible. So it can take very long. It can be very costly if you don't structure these things. And again, there's so many varying ways that it can turn out if it's not structured correctly. It might sound as simple as a bank account or buying a property for your daughter in the UK. When you pass away, there could be inheritance tax liabilities, which is up to 40% of the value. It could be, as I said, several months before that money actually becomes available to your spouse. Whereby, again, the wrapper, it's 3 weeks and the spouse has got access to capital to continue with the living expenses.
And I think that ties in so nicely with how people are planning for now and actually not thinking about that unfortunate event if they did have to pass in the future. So, like I said, a lot of people are making use of these types of structures to just simplify things, make things seamless and so on. And I think we got time for one last question, and it's a question we ask all of our hosts from that side, is if you had 1 million Rand surplus to requirements right now, how would you go by investing it?
Yeah, so thank you for that. My personal view on how I invest money is, I do think obviously it differs for age groups. The older you get, you need to look more at income, but I do think if you look at it as an investor, South Africa is a very small component of the world. I even heard it again today, your JSE 70% of the earnings, but it's 70% of the earnings with a very limited range of companies. So that's one point. So I think diversification offshore is large. Secondly, the majority of investors' assets is in pension funds and a property or two, and that is all South Africa. So my view is invariably take a larger chunk of your discretionary capital out directly overseas and investing into a greater universe. And I'm not talking because it's my game offshore. I've been doing offshore for 15 years, specializing in it in 10 years. So I do think the majority of that million Rand I would normally take overseas, because a lot of your wealth is already in South Africa, locked up in a way which you really can't get proper offshore diversification.
100%. And I sort of think that's why all three of us have jobs at this point in time. But thank you again for taking the time to explain everything to all the people here. I'm sure that a lot of insight was taken out of this. And thanks everyone for joining and offering up your time. Looking forward to next week. We've got Jeff Dorr of Overseas Trust and Pensions. We'll be touching on safety and jurisdictions. And I think that goes along with a bit of Etienne's talk on not only do you need to take the consideration in choosing where to take it offshore, what currency to look at, what type of structure to look at, but especially where to go and place that structure, because regulation and legislation, all these things play a huge role in someone's wealth for a long period of time. So yeah, I look very much forward to that, and hopefully we'll see all of you there. Thank you very much.
Just thank you, everyone.
Thank you.